Hello, and thank you for coming to the Quality Mortgage Services YouTube channel. Claudia and I have been kind of wondering about how to develop this channel a little more instead of sending out a lot of emails. So we just felt like it was better just to direct people to the video and or other people who are interested in knowing and learning about quality mortgage services rather than sending out emails. So this gives you an opportunity to view it on your phone or at your leisure instead of filling in your inbox with a lot of information and having to read a lot of information. I have actually written this for an email delivery, but we've chosen to take it, if you will, on the YouTube channel. So we're going to give this a shot and see how it works out. So basically it's time for another update, and this update is really about some of the things that I took away and gleaned from the Mortgage Bankers Risk Management and Underwriting Conference. Quality Assurance Conference. And there was a lot of information, more than I could glean for this particular presentation, but I think these items will really, I think, hit those who weren't able to attend and are really concerned about risk and some other operational functions within their QC and operational departments. So the people who attended from Quality Mortgage Services was Wade and Claudia and myself, and we went to Miami for this conference, and the information was massive. It was a lot. Wade took a lot of good notes, and we're looking forward to implementing a lot of things, or maybe just touching base with our clients as they feel free to give us a call about certain things. But there was some buzz and some conversations, and let me just kind of cover some of those items. Curing loans, and there's a lot of buzz about how to cure loans, and what's happening is this is driven based on, in my opinion, what Fannie Mae has determined as the defect rate reports. And what's happening is the scores are really, maybe, I don't want to say skewed, but off as a result of manufacturing defects coming into the QC audit and then having to be cleared out. I know that we try to identify missing documents on the front end before they get into the audit phase, but what we're going to do here is we're going to have something that's we call it a buy, or kind of an ability to do on-the-spot corrections before it actually gets into the final report where the scores begin. And what we're going to do is these will only be items dealing with the manufacturing of the loan or the manufacturing of the loan for quality control reviews and moderate findings. No eligibility issues will be pushed into this, because that's something that we feel like that needs to be formally rebutted and addressed in your action plan. We will be having this built, probably it'll be in action prior to November. I know Sherang is working on it right now, and we've already given the order, actually the day we got back, let's do this. But as you know, those have been working with us. We've been trying to identify those items prior to, but we're still getting things in the gross reports, if you will, and then when it gets into mitigated and clearing, it's still affecting the scores. So what we're trying to do is really help you to reduce your scores going forward. So we're having to re-engineer Mars just a tad, just to accommodate that. All right. There was a survey question posed to the audience at this conference, and I thought it was a pretty good question. It went something like this: how many loans does your underwriter complete in a day? And that stirred up a great amount of discussion, and it went very well. I think a lot of people were very liberal and very free about certain things about their underwriting operations. And let me tell you what I got away from it. Basically, most companies are doing about 2 a day, and I said, "You got to be kidding!" Someone asked me how many we're doing, and I told them. And they said, "How is that possible?" Well, that's because you're only just verifying. Well, I like to think we are very sensitive to our budget, and we accommodate processes accordingly to enable us to have a higher amount of turn times on these manual. All our underwrites are manual, so I don't know about you guys, but we have to have a better turn time for what you're paying for us to do. So I think as a result of that, we were forced into re-engineering the way we do our process. So let's get back to what other mortgage banks are doing. So there was about some that were doing 2 a day. if those mortgage bankers had 3 or more per day, they had to re-engineer their underwriting process, so redefine what we would traditionally call underwriting. And the way they did that, so we're talking about those mortgage banks were able to do 3 or more, so possibly 5 and 6. But what they did was, from the discussion that was going, they took away all the compliance checks out of underwriting. And supposedly what happened was it created a lot of real estate battles, if you will. This is my area and my name's on it. So there was a lot of kicking, a lot of disgruntlement and bitterness as a result. But after taking that, the compliance checks away and putting it under, and what people were saying, they're putting it under the compliance manager and not the risk manager. And that includes the change of circumstances that occur quite often, and having them make those decisions and adjust and do those things and validate those processes were correct. When it was posed back to the underwriters, would you like to have this back? Everyone said, absolutely not. We don't want it. We're happy with what we have. And then there was another part of the audience that said that we have split up our appraisal review as well as the compliance. So you have someone just looking at more of the credit analysis component, which they're calling traditional underwriting, and taking out the compliance. So credit analysis is a standalone. That's underwriting. Taking compliance and putting it over to a compliance team of experts, and then taking the appraisal and putting it on their appraisal team of experts, whether it's residential appraisers or really experienced underwriters. I don't know, but maybe a little combination of both. And they're able to obviously turn more than 3, possibly 5 and 6 a day or even more as a result of that. However, that had to come from the leadership above, forcing those changes, looking at where the center of gravity really is as per those processes. I did meet somebody that I would say would be a known mortgage bank in the industry, and their leadership has not made any decisions, even though this individual has promoted and tried to push and creativity, trying to be creativity into the underwriting process with much resistance from the leadership and the underwriters. They're only able to do 1.2 a day, according to this individual. I just don't see how that could be costs. I don't see how the cost can support that, and I'm curious if those companies that are doing 1 or maybe even 2 a day, if they can even continue to be in business with the costs associated with those underwriters. Now, I'll also say that those companies that were able to split up into 3 modules, let's say compliance, credit risk, and appraisal review, I believe those kind of mortgage banks own their own LOS, or maybe have taken a platform and modified it to their processes, from what I took away. And that's how they were able to do that. If you're using kind of an outdated, and maybe some LOSs that are more geared to brokers and not more the mortgage banking level, I'm not sure if they would accommodate. So I think that level, the people who were able to break it up in the 3 modules, were a little more robust in technology and process flows and that sort of thing. They were able to do that. I think they were a little larger mortgage banks. And then there was another group of mortgage banks, I would say they're depositories, big names that you would know, that have taken their underwriting offshore. And you say, how could they do that? Well, I knew this was happening for some time. It just mattered of when it was really going to be known that this is how they're doing it. But the way they're doing it, well, first of all, they have to be big enough to put a branch office in an operations center offshore. So you know that this year and last year there were a number of underwriting operations centers closed down in certain parts of the country. And I think a lot of that work was shift offshore. And this is how they're doing it. Offshore, what they'll have is they'll have a W-2 expert, and they'll have maybe a employment verification expert, and then they'll have all these little experts that just have a very niched kind of review, that they're only looking at certain things. They may look at hundreds of these things a day, but they're able to process it through and make comments or write any kind of defects, and it moves on. And then the culmination of all these people looking at their little piece of the pie culminates back into the U.S. and where the underwriting decisions reviewed and validated and then cleared to close. And I would say those individuals those institutions are big enough to be able to do something like that and possibly have their own LOS be able to accommodate that type of engineering and structure and processes. They did say it worked exceptionally well and very well. I don't know that for a fact. I don't look at those kind of loans, but I believe them if they said so. All right. Pre-funding was another hot topic. Let me tell you what I gleaned from this is that there are a number of financial institutions who are doing 100% compliance checks on their pre-funding. And I think that's a valid process, but I would also say, is it wise to do that onshore or have that outsourced offshore? It's just a decision that you'll have to decide where you want to assume risk. But there are institutions doing 100% compliance checks, and there was no detail about what they're looking for and what they're looking at, how much time they spend. I know a few weeks ago, maybe not quite a month ago, I was in an operation, and I asked some individuals, what are you doing? And they were looking through some files and using some kind of compliance platform built into either to the LOS or something separate. I really wasn't sure which. And they were checking the block and looking at the documents, clicking the block and moving on. I would say this. If you feel like a teenager could do that kind of work, you probably need to be outsourcing that in some capacity. All right. Maybe not all of it, but just look at the intellectual structure of checking those items and checking those documents. If my 14-year-old can do it, look at a document and see if it's signed or dated, maybe you need to outsource that. So there's 100%. There appears to be a lot of compliance checks done for pre-funding. There is still that certain percentage that's being looked at for risk for pre-funding. It didn't appear that it was a 10%, and didn't appear that it was necessarily random. It just appeared, just from the talk and the discussion, it appeared to be more discretionary and targeted, and then applied toward a percentage. So that's what I'm gleaning from this. I know that there's some policies out there that say that there should be a random sampling. Unless your LOS can target that, and when I say target, maybe randomly do that. I think that perhaps that random sampling is probably not a good fit for pre-funding. But there are people who are doing it. I would say discern and make your own decisions. But that's what seems to be happening. Now, whether or not those institutions are taking that pre-funding and outsourcing it in under a vendor, I don't know. But it seemed like a little bit of both. It seemed like there were some that had the ability to do the risk analysis pre-funding in-house, and there were others who were outsourcing that. So I would say this, just in all fairness, the trend appears to be that majority of there's a more robust compliance review done internal to the operation for pre-funding, and then another portion for risk analysis, or maybe like a re-underwrite validation that's being done separately. And it's just a balance between outsourcing and in-house. Okay, so just so you know. Now let's talk about something else. Fannie Mae did a really great thing while we were there. They released something, we call it ATQ, Audit to QC, but it's really under the Seller's Guide 2013-5 from last year, and it went into effect January 2014, where you're supposed to audit the QC vendor's work. And those who are existing customers know that we were the first to have it. We have it. We're the only ones that have it, as far as I know. And the spreadsheet that Fannie Mae offered was very thorough, very accurate. It was well done. However, guess what? If you take that spreadsheet and you begin doing that work, that's exactly what it's going to be. It's going to be a lot of work for a QC manager, or you're probably going to have someone drop what they're doing and manage that spreadsheet on your behalf. You really don't want to do that. You really want to use the MARS portal, the Mortgage Analyst Review portal, in order to help you do that. We have a lot of that information already established, and I tell you what we're going to do. after we looked at the spreadsheet, there were some reports that we could probably make a little more informational based, if you will, a little more robust as per information, and we could literally reduce some of those worksheets in that spreadsheet into one spreadsheet based on what we already have. So when you get into that Fannie Mae worksheet, you'll see there's multiple Excel pages or tabs. We're able to take at least 3 of those and combine them into one informational piece with dates and information that could be used. Now, we have a lot of that data already in multiple reports. So the good thing is this helped validate that we did have it all covered. But what we did glean from this, and we appreciate Fannie Mae kind of giving us this information we can kind of compare, because we had nothing to compare to, is taking some of that information into not only their worksheets but ours and combining it into maybe one operational document that can give you a lot of that information, so you're not having to click around and look in the portal for that information. So I think it was very positive. The conference was excellent. Thank you, Mortgage Bankers Association, for putting it on and allowing it to happen. And it was just way too much information for me to bring back in this 15-minute video. So anyway, I hope you'll leave some comments or you'll call us with some information in case you want to learn more about the Mars portal, or ask me some more direct questions where I can't really name names and that sort of thing, but maybe just kind of, give you a highlight of some other things I was able to take away. But anyway, thank you for coming to the Quality Mortgage Services YouTube channel, and have a great day.